In the ever-evolving world of finance, one name continues to shine brighter than the rest: Warren Buffett. But what's the real magic behind his success, guiding the colossal empire of Berkshire Hathaway? Let's find out. A key pillar of Warren Buffett's strategy and a lesson every investor should learn is the inclusion of enduring dividend stocks in his portfolio. But Buffett's success isn't just about picking any dividend stock. It's about selecting those with lasting value, adhering to his mantra, "My favorite holding period is forever." So let's discover 7 of Warren Buffett's best dividend stocks to buy and hold forever. Bank of America.
Investor Warren Buffett is giving a big vote of confidence to this country's largest bank, Bank of America. Buffett is investing $5 billion in B of A in exchange for a 6%.
BAC. Bank of America is the second largest holding in Buffett's portfolio, making up a substantial 8.7% of Berkshire Hathaway's overall investment. What makes it stand out? Its impressive history of dividend growth and resilience during the recent banking crisis. In the second quarter of 2023, Bank of America reported robust earnings, hitting $25.2 billion in revenue, up 3% from the previous year. During that period, it returned $2.3 billion to shareholders through dividends and share buybacks, showing a strong commitment to rewarding its investors. Speaking of dividends, the bank currently pays 22 cents per share quarterly, and the exciting news is that it plans to increase this by a solid 9% in the third quarter of 2023. With a dividend yield of nearly 3.3%, it offers an attractive income stream for long-term investors. You might wonder why its dividend yield isn't higher. Well, Bank of America's shares are attractively priced at just 8.6 times forward earnings, and they're currently trading more than 20% below their 52-week high. This indicates the potential for future growth while you enjoy those dividends. So while Bank of America's dividend yield may not be the flashiest, it offers stability, consistent growth, strong financials, and growth potential. That's why it's not only a core holding in Warren Buffett's portfolio, but also a top choice for long-term investors and maybe even a forever hold. Chevron.
So for an absolute safe way to get 5% instead of 1% or less, of course we'd take the 5%. And we feel pretty safe with Chevron.
CVX. Chevron is Buffett's 5th largest holding, accounting for a solid 5.6% of Berkshire Hathaway's total portfolio. It's a multinational energy giant that covers all aspects of the oil and gas industry, from exploration to distribution. Now, the energy sector has seen its fair share of ups and downs, with the S&P 500 energy sector taking a 7.45% dip year to date. But investors are still flocking to energy stocks, and Chevron is no exception. Why? Because they know Chevron comes with rock-solid dividends. In the first quarter of 2023 alone, Chevron generated a jaw-dropping $7.2 billion in operating cash flow and $4.2 billion in free cash flow, while returning $6.6 billion to shareholders through dividends and repurchases. That's one of the reasons why it deserves a top spot on our list of the best dividend stocks. With a quarterly dividend of $1.51 per share, yielding 3.89%, and a 36-year history of increasing dividends, Chevron stands out. Now, if you're still not convinced, consider this. In the first quarter of 2023, 64 funds owned stakes in Chevron, up from 57 in the previous quarter, with a combined value of a whopping $23.6 billion. So in a world of uncertainty, this is one stock you can confidently buy and hold forever. CocaCola, KO.
I mean, Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million.
Over 30 years ago, Warren Buffett made a brilliant move by acquiring a substantial stake in Coca-Cola, or KO, and it holds for 6.9% of Berkshire Hathaway's total portfolio. In 1994, the cash dividend Berkshire received from KO was a staggering $75 million, all stemming from a $1.3 billion investment. Fast forward to today, and you'll be amazed to know that last year, this dividend payment had surged to a whopping $704 million. Now, Coca-Cola may not be a flashy growth stock, but it follows a proven formula for wealth generation. Its affordability enables Coca-Cola to navigate through inflationary periods relatively smoothly, thanks to its ability to adjust prices without too much fuss. Plus, when it comes to cola, most consumers prefer the real deal over store brands, so competition isn't a major concern. If you're considering an entry point into Coca-Cola, now might be the perfect time. The stock has traded relatively flat over the past 3 years, making it a solid option, especially with shares currently priced at less than 24 times forward earnings. Coca-Cola has not only paid dividends consistently, but has also increased them for an astonishing 61 consecutive years. This achievement places Coca-Cola among the elite group of stocks known as Dividend Kings. As if that weren't enough, its current dividend yield stands at over 3%, making it an attractive choice for income-focused investors. Coca-Cola certainly appears to be one of Warren Buffett's forever stocks. American Express, AXP.
About 18% of Amex. And, everybody in the world wants to control payments. And I felt a little better, though. I was talking to Richard Fisher here just a few minutes ago. And
American Express, the renowned American financial services company specializing in payment cards, has been a stellar investment for Warren Buffett since Berkshire Hathaway acquired shares in 1995. Its net income was $41 million. However, in the last year, it surged to an astonishing $302 million. American Express currently boasts a quarterly dividend of 60 cents per share. Notably, this year, the company raised its payout by an impressive 15% in March. For a staggering 30 consecutive years, it has consistently made dividend payments to its shareholders. But here's another compelling piece of evidence for you: the rising interest among hedge funds. In the first quarter of 2023, the number of hedge funds owning stakes in American Express jumped to 77, up from 71 in the previous quarter. These institutions recognize the potential, and the consolidated value of their stakes now stands at a whopping $27.3 billion. So why is American Express one of Buffett's top choices for a dividend stock to hold forever? The numbers speak for themselves. A solid history of dividend payments, consistent growth of dividends, and the confidence of hedge funds. Kraft Heinz, KHC.
I think Kraft Heinz should pay down its debt, and it should. But I think under present circumstances, it appears that it can pay the dividend and pay down debt.
Kraft Heinz is currently Buffett's 7th largest holding, making up 3.1% of Berkshire Hathaway's entire portfolio. But don't let that percentage fool you. The connection between Berkshire and Kraft Heinz runs deep. In fact, it's listed as one of Berkshire's subsidiaries on its official website. Kraft Heinz, traded under the ticker symbol of KHC on NASDAQ, is a prominent American player in the food and beverage industry. This powerhouse was born in 2015 when Kraft Foods and the H.J. Heinz Company merged. While it's true that Kraft Heinz hasn't been the poster child for consistent dividend increases, they did cut their dividend in 2019. There's still plenty of good news to consider. First and foremost, the dividend yield is a robust 4.8%. And they pay out a quarterly dividend of 40 cents per share. According to the latest data from Nielsen and Numerator, packaged food sales are on an upward trajectory, gaining momentum. Even in the face of changing consumer preferences and market dynamics, Kraft Heinz has managed to offset volume weaknesses with strategic pricing. Perhaps it's the most compelling reason to consider Kraft Heinz for your long-term dividend stock portfolio. IBM.
I don't think so, but it could be. I mean, we've owned stocks we've lost money in, and sometimes when stocks go down, we're wrong and we sell them, and sometimes.
It seems like an odd match when Warren Buffett started buying IBM shares in 2011. After all, he'd historically steered clear of technology stocks, often saying he, quote, didn't understand them. But here, Buffett's wisdom isn't in question, and his move into IBM was more strategic than it might seem. You see, technology is notorious for its rapid changes. But IBM isn't your typical tech company. It's a high-quality blue-chip stock with a history dating back to 1911. That's over a century of weathering storms and evolving with the times. What sets IBM apart? Well, for starters, it's currently yielding a generous 3.6% in dividends, making it a top pick for dividend seekers. Plus, it's a rarity among tech giants with a track record of earnings per share growth at a steady 10% annually, and dividends growing at a breakneck pace of 20.4% yearly. IBM's payout ratio is just 43%. This means the company uses retained earnings to buy back its own shares, a move that increases value for every investor holding a piece of the pie. IBM isn't resting on its laurels either. It's shifting gears toward even better growth opportunities. Now let's talk numbers. At a price-to-earnings ratio of just 12.5, IBM stock is a bargain. And with 9.5% of Warren Buffett's portfolio, you can bet he sees the potential here. It's that high historical growth rate, low price-earnings ratio, and handsome dividend yield that makes IBM a compelling choice for those seeking tech exposure with the security of a time-tested blue-chip stock. Verizon, VZ.
Buffett's Berkshire Hathaway buying $4.1 billion worth of Chevron shares in the fourth quarter. It also added $8.6 billion in Verizon shares and $500 million in Marsh & McLennan.
Verizon is one of the top picks of Warren Buffett with its impressive dividend yield of 4.5%. Now, in today's world of rock-bottom interest rates, finding quality businesses with such high yields is a rarity. But that's precisely what Verizon offers. Verizon and AT&T are the giants in the U.S. wireless provider industry, each boasting around a 35% market share. Its payout ratio might seem a bit high at 63.8%, but thanks to those stable earnings, it's actually quite reasonable. While Verizon hasn't experienced explosive growth over the past decade, with earnings per share growing by 4.5% and dividends by 3.2% annually, they've got some exciting plans to change that. Verizon's management has been on a buying spree, acquiring companies like Fleetmatics for $2.4 billion, AOL for $4.4 billion, and Yahoo for $4.8 billion. These aren't small acquisitions, and they're strategically positioning Verizon for the future. These acquisitions are all about expanding Verizon's reach into media and advertising, transforming it from just a wireless provider into a wireless and content provider. As the world becomes increasingly digital, this shift could significantly boost Verizon's growth prospects. With a 3.2% historical growth rate and that attractive 4.5% dividend yield, conservative estimates suggest Verizon shareholders can expect total returns of around 7.7% annually. So it's a stock Warren Buffett believes in, and it certainly offers a strategic vision for future growth. As we come to the end of this video, it's pretty clear that all the stocks we have explored offer compelling reasons for long-term investment. So in the dynamic world of finance, Warren Buffett's investment principles hold valuable lessons for anyone seeking financial success. Before you click away, hit that subscribe button and ring that notification bell so you won't miss out on any of our future financial insights. Until next time, keep those investment dreams alive and stay tuned.